Hello everybody, I hope you're having a good summer. This is the July 2019 trade of the month for Pair Trade Finder Pro's top 30 US equity pairs. The signal came in on the 24th of June, and this is a pair that we've been trading for the last 2-3 years, and it was to go short MDT, that's Medtronic, go long Zimmer Biomet. And again, 10,000 a leg is what we use as demonstration side. So you were selling 84 shares short of MDT and going long 101 shares of ZBH. Well, what are these companies? Let's take a quick look and understand a bit better why we like them and why they make a great pair. Well, the first one is Medtronic. It's traded on the New York Stock Exchange. Share price about 102 yesterday. Market cap of 137 billion. Beta, very stable stock of about 0.5, and we put that up against Zimmer Biomet, and Zimmer Biomet is also traded on the New York Stock Exchange. Last price 138, so very similar prices, which makes for a good ratio. The beta is higher, 1.26. It's got a market cap of 2.83 billion, sorry, 28.3 billion. So Medtronic is the big daddy, and Zimmer Biomet is a little bit smaller than that, about 1/5 the size. However, they've done very well for us over the last couple of years. Let's take a quick look at a bit more of the profile. So they're both in the healthcare sector, medical devices industry subsector. One's got 101,000 employees based out of Ireland. The other's got 19,000 employees based out of United States. And Zimmer Biomet, together with the subsidiaries, designs, manufactures, and markets musculoskeletal healthcare products and solutions all over the world. Okay, and that's up against Medtronic, which is a company that develops, manufactures, and distributes device-based medical therapies, again, all over the world. And they cover a wider range of devices. However, both are in the medical devices space, and anytime you see that space reviewed, both of these names tend to come up as being key players in the space. Why do we, even though there's a discrepancy in market cap and beta, why do we think that they make fundamentally a well-matched pair, besides being in the same industry subsector and in the same line of business? If we go to statistics on both, we can see that the market really views their cash flow streams in an extremely similar fashion. So we can see here that the price to sales about 4.49, 3.6 for Zimmer, price to book 2.74 versus 2.4, EV to revenue 5 versus 4.6, EV to EBITDA 16.6 versus 15. So the market looks at them in a very similar way, and that reinforces the fundamental screen that we've already done that put them in the same industry sector, same line of business. So we feel very comfortable on the fundamentals of these two, and that's been borne out of the good results they've delivered over the last 2-3 years. Let's take a look at the back test results that caused us to select these in the first place. The last year has been less appealing than the year before. In the last 2 years, there were 6 trades. Co-integration has broken down recently. Over the last 4 or 5 months, it's broken down. When we put this into the top 30, that was back in March, April. It had a co-integration of about 0.9. So you might have decided you didn't want to take the trade because co-integration is broken down, or you may not even use co-integration in your screening. We do. However, we're picking it because it's still part of the old top 30. We've got a whole new set that's just been released this week. However, this is part of the old group, and we need to look at historic trades, so we've pulled this one up. Compound annual growth rate 11%, max drawdown about 11%, so 1-to-1 reward risk. Made $2,900 on, net profit $2,300 on those 6 trades. Average net profit of trade 384, and 83% were winners. Average days in trade was about 28 days. Here you can see the equity curve. The trade we're dealing with here is this last one, which did well. Here's the ratio chart. Again, the trade we're dealing with here is this last one that reconverged. You can see over the last, basically over the last 2 years, there's not a trending ratio chart. It's pretty flat, back and forth over the moving average line, which is what we like to see. So let's go and look at the relative performance graphs. That's something I always do when we are about to take a trade. So if we look at Medtronic versus ZBH over the last year, this is the relative performance. We like what we see. I mean, you're seeing relative performance diverges, but then it always tends to reconverge. That's the co-integration at work. And then here again, it's diverged, and on this large divergence here was where we entered the trade, and this reconvergence here is what brought it home and brought us the profit. So we take a quick look at that, and we can see historically before this trade happened that it has diverged and reconverged, which is very positive. Let's see what else we look at. If you want to do a price chart analysis, you can do this on both. The trade triggered here. There's a down day in the market in a share that's been ranging over the last year, and it then later broke out to a new high, but at this point it was within its range. It was just ranging. And if you look at Zimmer, pretty similar story. Down here it's within a range, slightly more negative price trajectory, but then it later went on to break out on its last earnings announcement. But it was just a ranging share. So neither of them were trending, both were ranging. And that would cause you to say, hey, look, it could be a very good reversion to the mean trade at this point. So that's a quick review of the price charts. So let's take a look at what caused potentially the divergence. Now, we always check for news. And we can see here that Medtronic, the signal was generated on June 21st. And on June 21st, we have nothing. Between June 1st and July 1st, there were no news releases by Medtronic, so that's promising. Then on Zimmer, let's just check this. There was a news release. There's nothing in July, but there's a news release 2 days before the trade was triggered, where Zimmer says they're announcing a chief financial officer transition plan. If you look at this and you read the story, it sounds like there's nothing traumatic about this transition. The CFO has been there 12 years, very close to the CEO. He's decided to move on. Very qualified CFO stepping in to take his place. And the old CFO staying on in an advisory capacity for as long as needed. So that's a pretty not traumatic CFO stepping down, because that can sometimes be a big warning sign. And if you want to check that, that was released after the market closed on the 19th of June. And if we go to the pair charts here, you can see where this triggered 21st. So it was released 19th of June. On the 20th, share prices barely budged on both these stocks. So that news did not have an effect. So we're clear on news. This is looks like a liquidity generated signal, which is great. The only thing we need to do now then is check for earnings dates and dividends dates. And if we quickly go to the fundamentals page again, I think you'll see it here. You've got on Zimmer, it pays a dividend, 0.71% yield, and the dividend date was 6 days into the trade. So that may have caused you to say, I don't want to take the trade because there's a dividend within it. There's also a dividend on the 5th of July for Medtronic, and Medtronic has got a yield about 3 times higher, 2.1%. And remember, we're going long Zimmer and short Medtronic. So if you take the trade, even though there's a dividend within the next 30 days, which is the average days in trade for this pair, you're going to take a bit of a hit on that, but not too much, probably about 0.3%. And we're looking for about a 4% return on the trade. So you're giving up 8 or 9% based on the dividend discrepancy. You have to make your own choice about whether you would do that. Earnings date on Medtronic, August 20th. That gives us lots of time. That's 60 days out. Earnings date on Zimmer, take 3 months away from that, was July 26th, I think they came out, which is just over a month past the day of the trade signal, the entry signal. So you would have had to decide whether you were willing to trade it, hoping that it would close the trade before those earnings were announced. Average days in trade based on the back test would suggest that it would, but it's a pretty close run thing. 28 days in trade, and those earnings were going to be released about 35, 40 days out. So something, again, to take into account when you decide. Earnings announcements, you definitely don't want to be in a pair trade when the earnings announcements occur. They can cause major dislocations that can have either a very positive or a very negative impact on your P&L, and that's not what you're playing when you're pair trading. You're playing a reversion to the mean from a liquidity driven event. So that would then take us to, so you have to make a determination whether you'd be willing to take that negative dividend spread and whether or not the Zimmer earnings announcement's too close. But had you taken the trade, or if you were willing to accept those risks, you would look at your pair charts and do a quick review. Over here we've got the last 640 days graphed, and here we've got the last 6 months. Okay, so there's a discrepancy in the time frames. That's just a bad data point in the RSI chart. If you look back over the last 640 days, you can see that this entry is more or less where the resistance of the plus minus has been happening over the last 2 years. So that's a comfortable entry point. And if you look at it to contrast that on the percent from mean, you can also see that this is at a maximum of 5% positive, but not breaking out, and not breaking out on the standard deviations either. We should check this 2 years back, which I did, and this is not a breakout either on the ratio. It's actually just up around resistance on the ratio. So then that would say to you, okay, no red flags there, looks good. Then we take a closer look at the last 6 months. We like to see divergence when we enter. So here we see the ratio has been creeping up. It's in an uptrend all the way from down here. And then we see the RSI is also in an uptrend following that, but let me just go back to this so you can see them side by side. The entry was called up here, which is a higher high in the ratio, but on the RSI you've got a much lower high. So there's a divergence here. This one's sloping down, this one's sloping up, and that's a positive signal when we're looking at for a turnaround. It's not an extreme reading, it's just over 60, but previously over the last week or two it's been way extreme. So that would suggest that it may be a very good time to get in because there's a turnaround potentially taking place with this divergence between the ratio and the RSI of the ratio. So that would be positive, and we would say let's have a look and let's do it. We can see there's a non-trending ratio, very flat line here. That's also very positive. There's no ratio breakout. The last thing we would review is just take a quick look at the volatility. This pair's got a volatility here, you see over here, of 3.61%. Oh, sorry, just below that, 3.31%. That's a volatile pair. Anything over about 2.5%, we consider a volatile pair. So you might not want to take it at a full position size. We might scale that down by 25 or 50% based on that higher volatility figure. Again, up to you, but that's always a little check we do before we enter a trade. So on balance, we think it looks pretty good. What happened had you taken it? Let's just go back to the pair charts, might be the easiest to see this here. So the trade, you're $100 down when you enter because of our commissions and slippage estimates. You never really went offside. It sat around doing not much, and then boom, around the 26th, when that earnings announcement did happen, it came very much in your favor, and it closed with $918 of profit on the 30th of July, a few days ago, 5 days ago. Interestingly, it did take the earnings announcements for it to reconverge. It did reconverge a bit. You got about 200 of profit, but it took that much for it to reconverge. So there you go. That shows you the danger and the opportunity of earnings announcements. So that was Zimmer, Medtronic, Zimmer, Biomet. And again, this is the detailed trade analysis of the trade of the month for July 2019 for the US